Good morning. I am the Economy Cupcake. It's July 7th, 2009. As we come to the end of our long 4th of July weekend with family and friends, conversations probably turn to the rapid decline of our housing market. All of us have our own opinions to the catalyst of the collapse. But an article in last Wednesday's New York Times that announced that President Obama is proposing a new consumer protection agency to regulate home loans seems to have us all a little worried. Michael Barr, Assistant Treasury Secretary for Financial Institutions, was quoted as saying, "The new agency will be able to get to the root of the mortgage crisis that we saw in the past." Wow, he must be the cutest guy in the Obama administration and way too busy admiring himself in the mirror to be so clueless of the facts that facilitated the housing crisis. I'll try to help him, but keep in mind, I do not have an Ivy League education. I did not pay attention to any of my classes when I was in school because I was too busy worried about my makeup. And I do enjoy an adult beverage, probably a little bit too much. But here goes. I'll try to help. There are three major events that helped facilitate the beginning of the housing meltdown. The first was a long ago law with really a yawner of a title called the Depository Institutions Deregulatory and Monetary Cap of 1980. Got through it, didn't I? It abolished rate caps for adjustable rate mortgages and made subprime lending viable for lenders. By eliminating the caps, it allowed lenders at their whim to set their own guidelines for the adjustable rate mortgages and home equity lines of credit. If you're one of the few in my state, which is Arizona, that still has their home equity lines of credit because, the banks all canceled them, your home equity line of credit could go as high, the interest rate could go as high as 22%. If you don't believe me, go check your note. The second event was the Tax Reform Act of 1986, eliminating interest deductions on consumer and auto loans. Now, I know that was a long time ago. Can you believe it was over 20 years ago? But what a great deduction that we used to have. We could write off the interest for our autos and credit cards. And I don't understand why they don't bring that back instead of this cash for clunkers. Just bring back the deduction for autos. But again, as you know, I didn't graduate from an Ivy League school. The Tax Reform Act kept the interest deductions on mortgages intact, making our homes an attractive source of financing. Take cash out of your home, refinance your home, buy a car, buy a plasma TV, use your home as an ATM, get your home equity line of credit. The non-stop commercials on our television and radio from the banks all but dared the U.S. consumer not to take advantage of our very own cash cow, our homes. These legislative reforms encourage the development of creative loan programs with imaginative underwriting rather than shutting the door on risky borrowers and properties. But wait, there's more. The third event was introduced in a 1999 article, again from the New York Times. Fannie Mae, under increased pressure from the Clinton administration to expand mortgage loans among low and moderate income people, eased the credit requirements on loans that it would purchase from banks and lenders. Peter Wallison was quoted as saying in this article, "If they fail, the government will have to step up and bail them out just the way they did in the thrift industry." But what could possibly go wrong? The perfect storm was seeded by the suits and the soothsayers that run our economy. Using our energy towards finding solutions instead of finger wagging could probably end the housing crisis sooner rather than later. If Uncle Sam is digging for answers, he only has to look in the mirror. But will he stop primping and take a long, hard look at himself? Thanks. This is the Economy Cupcake.